A tax deduction lowers our taxable income and thus reduces our tax liability. However, not all tax deductions are created equal. In the world of tax nerds, what is often called above-the-line deductions can be much more valuable than below-the-line deductions. Therefore, in today's video, we're going to talk about the 10 best above-the-line tax deductions, more officially known as adjustments to income, you want to be aware of. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. Before we get to our 10 best above-the-line deductions, let me briefly give you an overview of deductions in general. And please note, I'm not an accountant and this is not tax advice, just information to help you increase your overall tax knowledge. When we first sit down to calculate our taxes, we normally start out with our gross income. Gross income includes all your wages, dividends, capital gains, business income, retirement distributions, and other income. Now, because we don't want to be taxed on our gross income, this is where we start looking to deductions, so we can lower our taxable income and in turn, pay fewer taxes. And as briefly mentioned earlier, when it comes to tax deductions, they fall into two general camps. Above-the-line deductions, otherwise more formally known as adjustments to income, are the first batch of deductions we apply to our gross income, which therefore becomes adjusted gross income, also known as AGI. Our gross income was adjusted by all the above-the-line deductions we'll discuss here. Once we maximize all the above-the-line deductions, this is where the below-the-line deductions come in, also better known as itemized deductions. And most of us are probably more familiar with these itemized deductions because they're often the most talked about. Think property tax, charitable donations, and mortgage interest deductions. We'll talk more about common itemized deductions in a future video, but the main takeaway for now is to know that the above-the-line deductions can be more valuable because they aren't constrained by the standard deduction versus itemized deduction decision. And a lot of times we can't maximize itemized deductions because they combined don't exceed standardized deductions. But above-the-line deductions don't have this constraint. If this doesn't quite make sense yet, no worries. In an upcoming video, we'll go more in depth about itemized deductions. For now, just know that most often, these above-the-line deductions can be more valuable than below-the-line deductions. And above-the-line deductions are also generally very important because our adjusted gross income determines our eligibility for many tax credits. Credits such as child and dependent care, premium tax, and earned income tax credits. So more deductions, better for our tax credits as well. An interesting background, the above-the-line deduction got its name because the deductions used to be made on the first page of the Form 1040 tax return, above the line that designated our adjusted gross income. Remember that one for your next tax trivia. Alright, with all that said, what are the 10 above-the-line tax deductions that you want to be aware of? The first above-the-line deduction you want to be aware of is 401k contribution. To be technically correct, 401k isn't actually a tax deduction. Contributions to an employer-sponsored plan like a 401k or a 403b are already deducted from our paycheck before being taxed. Therefore, our taxable income is effectively reduced without us needing to do anything on our tax form. An actual tax deduction, similar to a tax credit, is something that we document on our tax return. But we don't deduct the 401k contribution on our tax return because the money has already been deducted. But with that said, the principle of lowering our taxable income is the same, so I decided to include it here in the list. In 2022, the contribution limit was $20,500, and this increases to $22,500 in 2023. Those 50 and older can contribute an additional $6,500 in 2022 and $7,500 in 2023. Given the pretty high contribution limit, you can get the best bang for the buck if you're in a high tax bracket. For example, let's say that you and your spouse have a decent income, so your marginal tax rate is 24%. If you're to max out your 2022 contribution limit of $20,500, you're effectively saving close to $5,000 in taxes by having that money invested in the market versus being spent. If you and your spouse both max out your respective 401ks, double the benefit. The second above-the-line deduction you want to be aware of goes along the line of retirement contribution, and that is an individual retirement account, also known as traditional IRA. Apart from an employer-sponsored plan, an individual retirement account is also a long-term savings account that individuals with earned income can use to save for the future while enjoying certain tax advantages. People who do not have access to a workplace retirement account such as a 401k most often takes advantage of IRAs. But technically, since anyone with earned income can open and contribute to an IRA, many individuals who have a 401k account through an employer still use IRA to diversify their retirement portfolio. And because it's not managed by one company, we have a lot more flexibility in the range of financial products. Products such as stocks, bonds, ETFs, and mutual funds. However, there are limits to the amount or contribution that you can deduct. These limits are based on your AGI before you claim these amounts as adjustments to income. Other rules also apply, such as whether you or your spouse have access to employer-provided retirement plans. The most an individual can contribute to an IRA is $6,000 per year for 2022, and this rises to $6,500 in 2023. The IRS also allows savers who are 50 and older to make catch-up contribution of additional $1,000. If you meet the criteria and you're looking to maximize your tax deductions, this could be a good low-hanging fruit. The third above-the-line deduction you want to be aware of is my personal favorite, and that is a health savings account, also known simply as HSA. A health savings account is a tax advantage savings account available to people enrolled in high-deductible health plan, also known as HDHP. Since people with HDHP could face more out-of-pocket costs due to higher deductibles, the government provides tax incentives to motivate people to save for those expenses. HSA in the personal finance and the financial independence world is also what is known as the ultimate retirement account. And the reason is because of what's often called a triple tax benefit. 1. Contributions to an HSA are tax deductible, just like all the other tax deductions we're talking about in this video. 2. The account earnings, if invested, are tax-free. Based on your HSA's provider, you can invest your money in a low-cost broad market index fund to appreciate. And third, this is a real game changer. Withdrawals, if you have eligible medical expenses, are also tax-free. Tax deductible going in, tax-free growth, and tax-free withdrawal. Triple tax benefit. Uncle Sam never gets a chance to touch your money. Also, because there's no time limit to reimburse yourself for the qualified medical expenses that you paid out of pocket, what many people opt to do is save their receipts and take withdrawals much later down the line once their account has appreciated. There's a lot here, so I have a whole video here on HSA if you want to learn more. For tax year 2022, you can contribute up to $3,650 as a single or $7,300 as a family. This goes up to $3,850 and $7,750 in tax year 2023. Those 55 and older can kick in another $1,000. The fourth above-the-line deduction you want to be aware of is student loan interest. All interest paid on federal student loans up to a certain amount is deductible. Anyone who pays more than $600 in student loan interest should receive a Form 1098E, Student Loan Interest Statement. You're allowed to deduct up to $2,500 or the total amount of interest paid, whichever is lower. The deduction is gradually reduced and eventually eliminated by phase-out when your Modified Adjusted Gross Income, also known as MAGI, reaches the annual limit for your filing status. The Modified Adjusted Gross Income is very similar to the Adjusted Gross Income, but adds back certain deductions. Many are rare, but they include rental losses, student loan interest, and 1/2 of self-employment tax. For 2022, the student loan deduction phase-out starts at $145 if you're married and filing jointly, and you can no longer claim this deduction at $175,000. For individuals filing themselves who are not dependents, the phase-out begins at $70,000, and you can no longer claim the deduction if your MAGI is more than $85,000. The phase-out cap increases slightly for the 2023 tax year, up to $185,000 for married filing jointly, and up to $90,000 for individuals. The fifth above-the-line deduction you want to be aware of is the deductions for unreimbursed educator expense. If you're an educator for kindergarten through 12th grade, you can deduct up to $300 spent on classroom supplies in 2022. If both spouses are educators, the deduction rises to $600. Since 2002, the deduction has been no more than $250, so this is a small but a nice increase for our hardworking teachers. I know of many teacher friends who are constantly spending money out of their own pockets for classroom supplies. Qualified expenses include teaching supplies, books, and other ordinary expenses commonly associated with education. This deduction is available to educators who teach grades K through 12 and work at least 900 hours during the year. If you're a hardworking educator or know of someone that is, make sure they're aware of this above-the-line deduction. The number 6 above-the-line deduction you want to be aware of is deductions for penalties on early withdrawal of savings. If you get hit with a penalty for withdrawing your savings early from instruments like certificate of deposit or savings bond, you are granted above-the-line deduction for the amount that you paid. Your bank should send you a Form 1099-INT or 1099-DIV if you have one of these penalties. Of course, these aren't good deductions to have because you don't want to be withdrawing your money early. But for whatever reason, if life circumstances force you to make this decision the past year, hopefully this deduction can ease some of the sting. Alright, moving on to number 7. Just a heads up, the remainder of the above-the-line deductions are going to be business related. Whether you have a side hustle or are self-employed, there are numerous ways to take advantage of deductions when it comes to owning your own business. The number 7 above-the-line deduction you'll be aware of is deductions for business expenses. Pretty much any expense related to the operation of a business is deductible on the Form Schedule C, a tax form to report income and loss for a business that you operated. This includes rent, utilities, the cost of equipment and supplies, insurance, legal fees, employee salaries, and contract labor. Now, don't go out and start a business just so that you can get these deductions. But know that the IRS code is written in favor of entrepreneurs. When I was working full-time and running my blog and YouTube business on the side, this deduction alone helped me save hundreds of dollars in taxes because my business losses also reduced my overall taxable income. The number 8 above-the-line deduction you want to be aware of is deduction for a portion of self-employment tax. If you're an employee of a company, you're normally charged 6.2% for Social Security and 1.45% for Medicare tax, combined 7.65%. This is known as FICA, a U.S. federal payroll tax enacted by the Federal Insurance Contribution Act and is deducted automatically from each of our paycheck. Though it doesn't feel great to have this amount deducted from our hard-earned paychecks, these payroll taxes help to run important federally funded programs such as Social Security and Medicare. Now, if you run your own business, you're responsible for paying both the employee and the employer portions. Thus, 7.65% times 2, 15.3% self-employment tax. It's a lot to ask for self-employed individuals, so to help soften the blow, the IRS allows business owners to deduct 50% of the self-employment tax as an above-the-line deduction to reduce the overall federal taxes. To be frank, paying this much self-employment tax really hurts, but at times, you can't have the cake and eat it too. The number 9 above-the-line deduction you want to be aware of is deductions for self-employment retirement contributions. If you work for yourself and you have your own solo 401k, SEP IRA, or simple IRA, you can claim an above-the-line deductions on your contributions. And deductions for self-employed business owners can be large, as the IRS allows you to deduct both the employer and the employee contribution portions. For example, let's say that you have a solo 401k because you own your one-person business. You get to make contributions as both an employer and as an employee. As an employee, self-employed individuals can make salary deferrals up to $22,500 in 2023, as well as an additional $7,500 for those 50 and older. For employers, individuals can contribute up to 25% of net income from self-employment. Total 2023 contribution can go up to $66,000 or $73,500 for those 50 and older. These numbers are slightly lower in 2022. The total solo 401k contribution limit was $61,000 in 2022. Now, of course, you need enough business income to be able to contribute the max, but as you can see, when you own your own business, you can contribute much more to your 401k plan than any company-sponsored plan can provide. The number 10 above-the-line deduction you want to be aware of is deductions for self-employed healthcare premiums. If you're self-employed, you can deduct 100% of health insurance premiums you pay monthly for yourself, your spouse, and your dependents. A little technicality here, this will be included as an ordinary deduction, not a business deduction. And in order to qualify, you must meet 2 requirements. 1, you have no other health insurance coverage. You may not take the self-employed health insurance deduction if you're eligible to participate in health insurance plan maintained by your employer or your spouse's employer. 2, you must have business income. You may deduct only as much as the net income you earn from your business. If your business earns no income or incurs a loss, you get no tax deduction. That's it, guys. I now covered a lot, so thank you guys for watching. And I know this stuff can be pretty dry and boring, but if you can glean some knowledge from this, it could lead you to some valuable tax savings for you and your family. In the line of taxes, if you'd like to learn more about tax credits, please check out my video here. Until next time, all the best.